Hello, and thanks for joining me on another episode of the Breneman Blueprint. So for this week's episode, I have a change of pace for you all today. I'm behind the mic as a guest. So last year, I joined the Cash Flow Connections podcast with Hunter Thompson and Tyler Lyons. Tyler Lyons interviewed me, and he did really a great job asking about why we invest in multifamily, what our strategy is, how we've created an edge for ourselves with our investments and the technology and team we've developed. So I wanted to go back and play this episode for you all. I think we covered a lot of interesting ground that maybe hasn't come up on the podcast before, or if it has, it was buried deep in a bunch of episodes. And so this one I think would be of a lot of value for you all, and hope you enjoy it.
Look, we all know that real estate has created more millionaires than pretty much any other business. The problem is, it's also created a lot of heartaches and bankruptcies. Sure, we can get access to a ton of real estate education on the internet, but that's precisely the problem. How can we tell which strategies will consistently produce asymmetric returns and which should be avoided at all costs? My goal is to give real estate entrepreneurs, capital raisers, and investors all of the secrets so that we can grow our portfolios without dealing with costly investment nightmares. And that's what this program is all about. I'm Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast.
Hello, everyone, and welcome to the Cash Flow Connections Real Estate Podcast. I'm Tyler Lyons, and I'm very excited for the guest we have here today. He is the principal over at Breneman Capital, and he began investing in real estate at the fresh young age of 19 years old. He has since dedicated his career to building an organization that makes investing in high-quality real estate opportunities available to passive investors. Drew Breneman, welcome to the show.
Thanks for having me. Appreciate it, Tyler.
All right, Drew. So I'd love to hear your origin story about how you got into real estate. As I mentioned in the intro there, you got started very early in real estate. I mean, you practically fell out of the womb investing in real estate. So would love to hear your story and how you got into the game of real estate.
Yeah, I mean, it's something that I really sort of just ended up falling into, but fortunately was at a really young age. I started a sort of like, I guess at the time we could call it like a side hustle, but no one had used that term yet. Selling items in video games. So this would be back in like the year 2002, give or take. And I had a friend who was selling items in these video games. Diablo 2 was the name of the game for anyone who's like my age, late 30s, who might have played that. And he said he sold his items for real money when he was done. He sold them on eBay. This isn't like a lot of money. He made like $20 or something, but kind of a light bulb went off, and I didn't really like playing those kind of multiplayer role-playing games or whatever they are called, but I was like, this sounds like a way to make money. I went on eBay, and sometimes like this stuff would sell for $10, sometimes it would sell for $20. It was really a inefficient market. I had obviously never heard of that term before, so whatever, a 15-year-old, but so I went on there, I bought something for $10, and I just resold it with a buy it now for $20, and I was sort of often going with that. It was just making money, $3 to $20 at a crack. But I would every day have like come home from school and I'd have like 20, 30 deliveries to make. And just over the course of 3 or 4 years, I made somewhere between 80 and 100 grand. I'd have to add it all up. But kind of the main point of all that was like I saved all the money. I already had a car. It wasn't much of a car, but it was like $1,000 Pontiac. And then I started reading like what people probably read normally when they're like my age now about investing, where I read Rich Dad, Poor Dad, Intelligent Investor. I did a book report on Think and Grow Rich. And so I just started educating myself. Both my parents are teachers, so there wasn't like not from like an entrepreneurial family, but they were into, my dad was big on investing in mutual funds. So they were good about living within their means and investing money. Like we never borrowed money to buy a car. Like they had a lot of good actual like financial advice just as for like a kid to take in. I just kept reading and, checking out books at the library, and I really liked real estate. This is a real estate podcast, so I think we get what's great about it, but I really like the cash flow, the tax breaks, appreciation, paying your loan down. It's not correlated to other investments. And for me, at least the light bulb went off. I'm reading this example. It's in the Gary Eldred real estate investing book, which that's the one I recommend for everybody if you're just need the basics on real estate investing. His example was you put 10% down on a duplex, it goes up 3% a year. And I'm reading this in like 2003, and this homes have gone up, probably 3% on average since the beginning of time at that point. So this sounds like a bulletproof info here. And a 3% appreciation on 10% down, that's a 30% return. I got real interested hearing that. So I'm from the Milwaukee area and was already going to go to college at UW-Madison in Madison, Wisconsin, and decided I'm going to buy my first rental property once I move there and just get going. And I did. I bought my first deal when I was 19, was a duplex for $216,000, lived in it, kept it real simple on that first deal, just made sure it was cash flow positive and the gross rent multiplier made sense, bought it, and just kind of been off and going ever since. So
That's awesome, man. That's a great story. And as somebody who's also from the Midwest and who also had a beater Pontiac as his first car, I can totally relate with a lot that you're saying there. That's terrific. So you bought that first duplex. You were in college at UW-Madison. Where did your career kind of go after that? Did you actually work for large institutions before you kind of struck out on your own to start your own firm? Like, what were kind of the next steps there?
yeah, so I didn't really know anything, let's say, about raising capital. And also I was, would have been 21 at the point where I was at this point. But I bought 4 deals when I was in college, 2 duplexes and 2 3 units. And so I had invested all the money that I had at that point. And then also I graduated in December 2007. So you could tell like the real estate market wasn't, it was about to fall. So then it seemed like a good time to go just to learn. So I decided to get a job really just for the education. And so I worked initially, I had an internship at an office developer in Madison and then worked full-time at a multifamily affordable housing developer in the Twin Cities. And then later worked for a retail developer. All that was really over like a 3-year period. So I learned a ton. But what I did, I was sort of always an entrepreneur that whole time. Like the places I worked, my coworkers, they knew I had bought deals prior, and that's sort of where my heart was, So like I think I understood. I'm sure I was a good employee because I really understood things from the owner perspective, but it wasn't where I was going to spend all my time. So I really, the whole time I was working, I was all at a job. I was also still building up my personal portfolio. One of my coworkers, an intern where I worked in Minnesota, I told him basically the same story I'm saying now. And he's like, we should go talk to my dad. He's been wanting to get into real estate investing. I think he might be interested in this. So I don't like to waste time. I'm like, let's go meet him tomorrow for lunch, and printed out a bunch of deals and went and met up with them. And they really liked one of these shopping centers I printed out in this meeting. And I showed it, it was a $3 million deal, at least at the asking price. And I was, kind of surprised because, again, having parents as teachers, you're talking to a guy now who could potentially put like $1 million down on a deal, or 600 grand, depending on how you want to set it up. So I was like, you guys understand, like this is like a pretty big down payment. Like, and they were like, yeah, they like, of course we do. And I still remember the whole process and getting it closed. And again, like the amount of money that went into this deal, my parents, they could have sold everything they had. They couldn't have wrote this check. And I still remember the feeling getting that first one closed with a partner, seeing that kind of money come into a deal. And then just over the next, call it from 2009 to 2011, the 3 of us, we bought 6 deals for $25 million. This all in Minnesota, commercial properties, 4 shopping centers, 1 office building, 1 industrial deal. And then at that point, I had quit my full-time job. So I was really working like 3 jobs for quite a while, where I had my own buildings that I moved to the Chicago area. And so I started self-managing those ones in Madison, just where I could just do it better. And then I was buying these deals on the side. Plus I had a job. So, it was a grind for sure, but, it paid off on the other side. I wouldn't trade it for anything. So.
Awesome, man. Yeah, I really respect the hustle there. And I can relate to that. I know when I was kind of coming up, I maybe didn't have 3 jobs, but I definitely had a couple of very demanding jobs with my own personal portfolio, and then kind of working corporate finance during the day as I was kind of learning the real estate industry. But yeah, I love to hear that, man. I love to hear the stories when people just really grind it out for a period of time and then eventually it pays off. And with you started out, buying those smaller properties first, and then you were into the shopping centers and then the industrial building. Eventually, though, you found the world of multifamily, which is what you focus on now. Why multifamily and why now, man? Like, why is that your focus now? Why do you like that asset type?
Yeah, well, I think, what we were trying to buy multifamily from the get-go, but there wasn't that much distress, at least where we were looking in the Twin Cities in multifamily in 2009, 10, 11. Whereas in these commercial deals, we were buying usually from the developer, and they might have had like 10 developments somewhere in process. And then we were buying like the one stabilized good property they had that was, 80% or 100% occupied. And so that was like a moment in time that made a lot of sense. So we were buying at 8 and 9 caps and borrowing at 6. You put 20-25% down, you generate like a high teen cash on cash on that. There were some deals where we're like, oh, the cash on cash is only 15. Maybe we should like pass on it, because the last one was 20. So those were, that was a moment in time. And as cap rates came down on the commercial stuff and got a little closer to multifamily, we pivoted back to multifamily. By that point, I had moved to Chicago and really started focusing on, we'll call it like core plus and value add multifamily, where core plus, this is like newer properties with not a lot of construction or anything to do. And those deals on a risk adjusted basis, very attractive because you're not taking much of any execution risk. You're just hopefully making your money on the buy and buying it right in the right markets. And then, value add, there's something you're going to do, renovate it or just mark all the rents to market. So then at that point, that was the better play. But in terms of like a product type, we went back, and I didn't have this info at the time, but I was able to calculate this later once I, quite frankly, hired someone who was capable of calculating something like this. But we took all the NCREIF data from 1990 to 2020, and then we measured all possible hold scenarios, 3, 5, 7, 10 years for all the major product types. And so industrial, multifamily, office, retail, and multifamily for every scenario had the highest returns and the least volatility in returns. Except I think one of the, like on a 10-year hold, one of the product types beat it out for volatility, but not on returns. So like just it's proven out in the data that multifamily is the best in terms of from a risk reward standpoint and just in terms of total returns. As you own those commercial deals, you realize like, hey, this shopping center or office building I bought with 3 or 6 tenants in it, you lose a tenant or two, the building doesn't make money anymore. Now you got to fill it back up, put in a big bunch of money to re-rent it, build out the space. So, apartments, what I love about them is you have so many different tenants paying rent. Some of the buildings we have over 100 people paying rent. For the most part, they all work at different businesses, making money in different ways. So you have a much more diversified rent roll than some of these other product types. Like in COVID, we had 99% collections on our apartments. And on the commercial, I feel like I spent all my time talking to our commercial tenants during COVID, where that working out rent deferrals and all sorts of different deals just to keep. We didn't have to end up forgiving any rent. Most of these tenants we have, and what commercial deals I still have, frankly, they're a bigger business than we are. It's like Verizon or Panda Express or Panera, Sleep Number. So, it was like we just did like deferrals, not forgiveness. So what else? All the trends are in the favor of apartments too. Current renters are renting longer. Like home ownership's getting just more and more expensive and out of reach, unfortunately, for a lot of people. But that's keeping them in the rental market. Gen Z, which is like a third of the population. They're just like coming into the rental market now. We also calculated like over time, like the vacancy rates. We did like a cutoff of 1990 in this calc, but when you look at older properties versus newer, so let's say 1990 or newer, multifamily has the least difference in vacancy out of all the product types. So if you think of like just maybe the most obvious examples, like an old office building or an old shopping center that you might know that was like maybe a hot property when you were a kid, like the shopping center that I went to when I was a kid that had the drugstore and then something in the grocery store next to it. That's changed so many times to a Hallmark store, to an Office Depot, to nothing, to like where it hasn't done well over time. Meanwhile, like apartments, it's like they do get still less functionally relevant, like all the properties, but much less so. Like even you drive by an old building that's an apartment deal, it's still, full and people are living there.
Yeah.
And then kind of, I could keep going, but lease term being a year is like perfect, where it's not like a hotel where you got to re-rent the dang thing every day, or storage is usually basically month to month. And then commercial, if you got inflation, it's, the leases could be too long. You might be locked in 1-2% bumps for 10 years. And we got, rents growing in some of these markets, 10+%. So, but yeah, just so much to like about it. Best debt availability with having the agencies, Fannie, Freddie, HUD in the market as well. All the lenders know it's the safest asset type, so they lend much more aggressively on it. So once you start really just looking at it objectively, it's like there's nowhere else to be.
Yeah, it's a great response, man. You hit on so many reasons why we also at ASIM Capital love multifamily and are really focusing on that a lot more moving forward. As I think about a lot of those factors that you just mentioned, I mean, at the end of the day, it really results in like, hey, look, multifamily compared to many of the other asset types out there tends to be one of the lowest risk sort of investments that you can make in the space, given the many things that you mentioned. You're investing at the kind of the base of Maslow's hierarchy of needs as well, right? It's like people need somewhere to live. So yeah, for all those reasons, multifamily is an excellent investment type and something that we believe in very strongly. When it comes to multifamily, there are a lot of great markets that you invest in. For you personally at your firm, you're in a few different markets. Talk to us a little bit about the different markets that you're in. What's the thesis behind each? Let's start there. Yeah, what are the markets that you're in and why do you like those markets?
Yeah. And I think so my first, call it 15, 16 years of investing in real estate, I was only in the Midwest, did my deals in Madison and the Twin Cities and in Chicago, like I said. And I felt like we were doing in those markets some of the best deals. I mean, probably everyone thinks this, but it's like where you'd buy it and you're like, wow, we did everything right on this deal. We bought it right. We executed our plan. And then you look at your returns and we have great returns. Our average IRR is 25% on realized deals, and on the unrealized ones, it's similar. But then you look at people who are buying deals in the Sun Belt and they're hitting those kind of numbers on like any deal, it feels like. And you start looking at why is this happening? And like the apartment market, it's like a simple business. It's where are the people going? It's actually one thing we looked at was the different correlations, what's correlated with appreciation. And surprisingly, supply was not correlated with appreciation. So even though some of these markets get a bad rap that get overbuilt sometimes, like Dallas or Phoenix, the numbers don't really bear that out. I mean, they have some of the highest appreciation in those markets out of anywhere. So I guess basically in 2020, 2021, I'm like, why fight this trend anymore? I need to be part of this. So we started buying in Phoenix, and we're also getting going in Dallas and Austin. And really like why those markets? I mean, Phoenix, that's had, I mean, like astounding appreciation, like in recent history. Like even if you back out the COVID times, so let's say like 2013 to 2019, multifamilies appreciated 14.4% a year. The rent growth during that same time period was 7.3% a year. So that's the number 2 market in that time behind Reno. And so like, even though like you kind of feel this is happening when you're in Chicago doing these deals, then you start backing up. Let's look at the data. This is what I was doing during, COVID and the year after, was actually like, what the heck should I be doing? Because in my Chicago deals, like I said, we bought them right. I did, I think 13 deals in a row. We bought them and then we would raise the rents to what we thought. And then we did a cash out refi of all the equity, on average over 100% of the money we pulled out on 13 deals. And then we would put it in again, do another one. And our rents were like never growing after that, or not enough where we were getting meaningful NOI growth. We would get some rent bumps, but it wouldn't be enough to offset all your OPEX and its increases. And it's just like, wow, this is turning into a harder thing to grow your NOI in. Meanwhile, you have places like Phoenix where rents are popping 7% a year, not just like for a year, for 6 years. And that time frame I'm talking about, that's before COVID. If you include COVID in that, it's double digits. Obviously, if you start mixing in 20 something percent a year growth with 7 prior. And I mean, yeah, so we are in Phoenix because I mean, the number one predictor of rent growth or appreciations, prior performance, and it's had that. And like population inflows, I mean, that's basically just like a bet against California, for lack of a better term. Like that's like the number one place people go after, if they want to move out of California. And like the people who apply for apartments, like that bears it out. It's just a flood of people coming out of California. And so like that's why we're in Phoenix, and they have the best property tax laws from an ownership standpoint in the entire country. So they have this thing called Rule A there. And what it basically dictates is the assessed value cannot go up more than 5% a year on a property, and reassessments do not occur upon sale. And so if you think about that, now you have a market where rents are growing on average 7+% a year. Your taxes are capped out at 5. Plus they're super low already, where this is like an apples to apples comparison. In 2020, during COVID, we bought a deal in Chicago in the West Loop neighborhood for $32.8 million. And our taxes on that are $525,000 a year. I bought a deal in Mesa, Arizona for $26 million. and our taxes on that are $38,500 a year.
Wow.
So like even the like so you're also so you're growing a tiny number, and they have a state surplus, so they're not in a situation where like they're trying to squeeze more money out of the people like we find ourselves in Illinois here. So yeah, there's just so much to like about Phoenix, and it gets a bad rap for the supply situation. But I mean, right now, and sure, numbers, it sounds like a lot's under construction, but it's 7.9% of existing inventories under construction, and the average for the Sun Belt is 8-something%. So it's not out of line with the average at all. I mean, Phoenix is volatile, so you got to know how to play it. Where when things are running well, like it's you're gonna crush it, and then when things pull back, they pull back pretty hard. So I think right now is potentially a good time to just be careful with what you're buying. You got to really be careful. Market's going to turn positive again everywhere. It's just you have to be still in the market and ready to go when things do turn, because obviously prices have fallen this year, back half of last year, everywhere. Phoenix, no exception. But once things start making sense again, where you're not buying a 5 cap and borrowing at 5 something, and all of a sudden maybe your rents feel like they're below market because things have turned, you got to be ready to buy. So I think, keep that in mind with Phoenix, that it's volatile. I mean, Dallas, we like Dallas kind of, it's a nice mix with Phoenix because it's essentially like the next core market now behind LA, like these institutional groups where before they wanted just New York, LA, San Francisco, Boston, and primarily because they're resilient and you have crazy liquidity when you want to go sell. Like everyone in the entire world is familiar with those cities I just said. So if you're from China and you want to buy in America, you're probably not looking in parts of Florida. You've never heard of those places or been there, but New York, you understand. So the institutions were always in these places because of the liquidity, but just like the numbers have been so astounding on the Sunbelt growth the last 7 years that now all the institutional money is in the Sun Belt, and Dallas is the most resilient growth market. It's very diversified. When you look at the rents and price action of single family homes and apartments over the last 20 years, Dallas is extremely resilient. So you have essentially like a core resilient market with a growth edge. So like that's a really nice pairing to like a Phoenix or people who, let's say, would also be investing in Florida, let's say, where that's also a volatile place. So then you got a lot of stability in Dallas. And then why Austin? Austin is just head and shoulders above all the markets in the US in terms of the demographic and economics. Like the things that are actually like predictive of the rents and price appreciation. Like it's got the best 5-year population growth out of any market. It's 2.5 standard deviations above the national average. For job growth, it's number 1 as well. This is a number 1 out of the top 37 markets. So if there might be some smaller place beating it, like I don't know if Bozeman makes the top 37 or not, but so it's the best in just sort of every category you'd want to look at: population growth, job growth, GDP growth. It's number 2 out of all the markets, except actually San Jose is ahead of it, which is surprising because there's like the American economy. I mean, it's so much tech. And so you have, in 2015, I was thinking maybe I should be investing in the Bay Area. Like this entire US economy is just like, seems like it's like tech. Why not be looking there? And a lot of that shifted to Austin. And so that's how to play that, and it's just sort of top of the charts on the important stuff. It's got that cool factor. Elon Musk, we're trying to figure out where to move their headquarters for Tesla. And I mean, his quotes was just everyone just said they wanted Austin. So it wasn't like there wasn't like a lot of analytics. It sounded like it was just, I want to keep my employees. They don't like living in the Bay Area where like a starter house is $5 million anymore. And they all wanted Austin. So it's got that cool factor. And then too, if you get all those corporate relocations to, let's say, Dallas and Austin, these people are going to stay there because there's a lot of like upward mobility potentially, just the same things that you'd like about normally those core markets like a Chicago, New York, where you can be the, like in Chicago, we have Boeing, all these different companies that, used to be headquartered here, where you could become the CEO of that someday. I mean, all that's moving to these, big Texas cities. So, I mean, those are where we want to play now. I think right now it's kind of, we've been running these deals, all from Chicago. But I think as we sort of build out our infrastructure here, like we're going to be in every market physically. So like for Phoenix, we have 5 deals there now. I go once a month, and then my asset manager goes every other week. Like he's there right now. And then we'd go again in a couple Fridays and I'll be there with them because it's a lot of this, it's a relationship business. So it helps being there. And then obviously you need to see your assets. So then you have to be there frequently. So, has created a bit of travel, and it's definitely different than before where you want to tour a property, you just pop over and check it out. And is so easy before. So it's a little more difficult now, but we're investing in better assets. So it's definitely worth it.
Definitely, man. Yeah, that's excellent. And in the different markets that you're looking in right now, are you looking for different product types in each market? Like, are you doing more of the traditional kind of value add in certain markets, but looking more core plus in other markets? Does that vary at all in these different markets that you're looking in?
Well, I'd say so in 2021, really the only thing that made any sense from a return standpoint were value add deals. It'd have to be pretty heavy value add because if you're going to buy let's call it a core plus deal. So that's just to describe that. This is like a newer property, built, let's say probably 2000 or newer. And there's really not much to do to it. You just buy it and run it. But at that point, like these things are selling for 3-something cap rates. There's loss to lease that you would capture and it would turn into like a 4 yield on cost. So 4 cap once you mark the rents to market. But you're borrowing in the high threes, like you're not generating any return. Then you got to assume you sell it at a higher cap rate. So those deals didn't really pencil well. So all of our deals in Phoenix had some element of value add on them, from pretty heavy renovations to lighter ones. But like today, I would recommend people focus on, and we're focusing on, are just really think about the risks of the deal. And like right now, it's a tricky time. Prices are down. Things could get worse, or they could just improve from here. It's, you always sound smart saying things are going to get worse and the sky's falling, but you don't make any money investing like that and just sitting around. So like in 2009, the deals we were buying, well, we thought about it was, okay, things probably are going to get worse. We want to put this money to work. We're buying deals at 9 caps. It used to be 5 and 6 caps. And let's just focus on deals where the rents are at market. So we're not overpaying for like above market rents. And there's enough lease term. Again, these were commercial deals. So enough lease term and enough loan term to get us out of the woods. So then all the deals we focused on, most of the tenants had leases beyond 5 years. Same thing with our loans. So then you're buying that, you're going by 2014. There's no way we're still in the dumps economically. And with that kind of mindset, like you should not be afraid to pull the trigger on a deal that makes sense. So, you want to do a 1, 2, 3 year hold renovation deal. I mean, I don't think now's the time for that, where you have so many moving pieces. You have risk on the debt because you're going to need to refinance that because you can't put a permanent loan on a deal like that right away. You got business plan risk in terms of just executing the thing. You probably don't have proven out rents. And it's like, now's not really the time for that. I think like the deals we're focusing on are newer ones, longer term holds, 5+ years. Personally, I've done about 30 Freddie SBL loans, which that's a really nice program for anybody listening, where it's non-recourse. They can go up to 80% LTV, 120 debt cover, step down prepayment penalties, which is the biggest part of it, so it's a fixed rate loan and you can get a step down prepay. So like if you're sort of protecting your downside, because these are fixed rate loans. And so you put on a fixed rate loan, your deal should work with that financing structure. But then if interest rates do drop, like people are predicting, you can refi without paying a crazy, 10-20% yield maintenance fee on the way out the door. And so a step down prepay, that's just something where it's like a certain percentage defined each year. So like if you did a 5-year, just sort of standard, Freddie SBL loan, it's going to just be a 5, 4, 3, 2, 1 prepay. That's the prepay percent of the loan balance per year, just said sequentially there. But like, so I think like that's a program I'm trying to do more of. Like, so we're looking at like, it's there newer townhome deals where, you buy it at a cap rate above where your debt's at, you get your rent growth. Like it's just, it's basic stuff, but we're trying to not take on too many risks to just sort of make a deal look good on the computer screen. But then, if the things do decline from here, you have a half open renovated deal that you're renovating at lower rents and it's an older property. So we're trying to reduce risk right now. And then I think and be ready, where one thing, this kind of like I was mentioning before, like whenever things are going to turn, let's say positive in the real estate market, it's going to happen fast. It's going to be something where it's like, Right now, it feels like in most markets, rents are falling or flat. That's in the numbers. It's not a feeling, like that's what's happening. And then cap rates have increased depending on where you're looking at. I mean, they're up. Most markets are in like the fives now for a cap rate on multifamily. But once it makes sense and you feel like, hey, actually those rents feel low now, I can buy at a 5 cap, interest rates all of a sudden in the fours, a lot of deals going to start making sense. And so you need to be ready to buy when that happens and ready to go. So, I mean, what we're spending our time on is just doing what we normally do, looking at deals, calling owners, talking to brokers. 80% of the deals I've bought so far have been either off market or through a repeat broker or repeat seller. Mm-hmm. So, just the basics, like be known as a closer, work who you know, and just keep the deals flowing, and eventually it's all of a sudden things going to work. So
yeah, that's excellent, man. In the market right now too is a little bit, as we know, there's a bit of a bid-ask spread right now, and the market's a little bit funny. Everybody's trying to figure out what's going on. Everybody's trying to figure out, should we buy deals right now? Would love to get your perspective here, because I believe you are still active. I'm not sure when the last deal was what you closed, but I'd love to get your perspective on, just what type of deals to do today. What do you need to see? It sounds like maybe a bit newer vintage. You're trying to risk off a little bit, but what do you need to see more specifically, like in the underwriting, to be like, hey, you know what? This is a fast ball down the middle. We're going to pounce. We're going to go after it. I'd love to hear your perspective on just like what that would look like.
Yeah, I think so. Again, we're trying to find the deals like I was talking about, newer, longer term holds, less moving pieces. Ideally, fixed rate debt you could prepay flexibly if you need to. If interest rates do drop, you want to take advantage of that. And then we're trying to underwrite, reality where, it's so easy the last few years where rents are growing, 10+% in the Sun Belt, and just things are growing to the sky. And now like that's not happening. So like we're just underwriting, like kind of, I guess like the correct way people say you should do it. Okay, you buy at 1 cap rate, you assume you sell at a higher one. We trend our cap rate up depending on the hold period, 5 to 10 basis points per year. And then I guess we would do more than that if it was like a 3-year hold, but we're not really looking at that hold period right now. And then for rent growth, I mean, we're assuming no rent growth year 1, 2% year 2, and then from there 4% per year. And like with that sort of assumptions, yeah, like not a lot of things are going to work, because we're probably competing with people who are looking at like the stats I was rallying off at the start, where it's like rents normally are going up 8% a year. So I'll just be conservative and do 4 every year. And then they're going to, that makes a big difference in your underwriting, having no rent growth for a year or two. One of our analysts is like, this is going to kill every deal. And it's like, well, I don't really mind that. Like, I'd rather these things like go well for everybody. We don't just need to get things like close to close them. So, but yeah, I think, there still is a bit of bid-ask spread out there. But what's interesting is like buyers are still stepping up. I mean, we got emailed a deal in Austin. It was just like a coming soon email, and it wasn't even out yet. And we were like inquired for some information, like, oh no, it's already under contract. And it's like, okay. And we looked at it. This wasn't like, they put it out there at a 6 cap and just gave it away. This was like a 3-something cap rate. We underwrote it just to see what the heck's going on. And same thing, a deal in Phoenix, we were looking at a smaller one that we underwrote to like $7 million, and it went under contract at 8.5. And so like, there's still like, there is a bid-ask spread, but it seems like it's less than you would think, where there's still some aggressive buyers out there. I mean, I still seeing deals go for sub 5 cap rates. I mean, there's some people are being creative, they're getting seller financing on some of these deals. You see that happening, but then that's tricky because, you potentially are overpaying just because of the favorable debt. So you got to like kind of factor that in your numbers. So, but keep that in mind if you end up in a seller financing deal.
Yeah, definitely. I've got one last question for you, Drew, as we start to wind it down here. What would you say Breneman Capital's secret sauce is? I can tell from this conversation, you guys really think things through thoroughly. You're very careful with your analysis, and you're not just jumping into deals and being aggressive just for the sake of getting deals under contract and racking up fees. So what would you say your secret sauce is, man? I'd love to hear you elaborate on that.
Yeah, I think, really like a lot of companies, they have similar strategies. So it's a good question where like, I think it comes down to, being specialized. So at the start of my career, like I was saying, I sort of would have done any product type around where I lived. And So I was, knew enough to be dangerous about each product type and had worked in it, but I wouldn't call myself like I wasn't like a true expert in, industrial and office and retail and multifamily. So, I mean, our secret sauce, I'd say it's that we specialize in just multifamily, just a couple types of multifamily where we only buy built before 1980 on the value add side. And then the core plus, we only buy in even newer than that and only in a few markets. So again, we specialize in multifamily, but we don't try to act like we understand where the best locations would be in Las Vegas and in Denver and Utah and Nashville and all over. Like we're just focusing on just certain things and doing that really well. And then to the off-market deal flow, I mean, that's a lot of people could be doing the same thing, potentially still that we're doing, but we're actually generating that off-market deal flow. And then team and technology, like some of the technology we built out, and maybe we talk about it another time, but we have built out like a AI machine learning rent model. We have a price appreciation model that we made and back tested, and that's how we landed on these markets. That's pulling in just a million different factors, and that's how I knew all those correlations was from the work we did on that. Our underwriting model that we have, one of the guys that I hired, he was working at like a $50+ billion private equity shop, and during COVID, he's like, I just will remake this model to something way better. He made that model for them. That's the only one they use now. And then we've improved it a ton since. So, I mean, like the tools we have, like really, I don't think anybody can compete with us from a strategy and a tool standpoint on the deal sizes that we're doing.
Got it. Love that, man. That's super helpful. And I've learned a ton from this conversation too, Drew, just being able to pick your brain a little bit about the multifamily space and understand how you think about it. It's been an excellent conversation. If people want to follow you and what you got going on at Breneman Capital, what's the best way to do that?
Yeah, just go to our website. It's breneman.com. So B as in boy, Reneman. You can sign up to be an investor there if you'd like. We work with individuals, like busy professionals, invest, $50,000 to $100,000 on up to one family's invested over $20 million with us. We have a passive investing guidebook you can download as well, which that's got a lot of just good things for LPs to check out, just how to evaluate a sponsor, different types of risks to look at, how it all works, break down like the different ways you make money in real estate, just kind of everything you could imagine. There's a huge glossary with all these fancy terms too, if you want to know like what a debt yield is. And then lastly, I have a podcast too. One thing I was really I really love the Cash Flow Connections podcast, and I was really love Hunter's book, The Raising Capital for Real Estate, where that, and this is not a paid endorsement here, I guess, or that when it came out, I listened to it on Audible, and his strategy of having the investors come to you, I mean, it's brilliant. And so like, that's one of the things that motivated me to start a podcast where my parents were teachers. Let's give this a go, teaching people about real estate. And so I wanted a podcast that was going to be for active investors as well for passive investors. So I try to go back and forth a little bit. Like one episode, I'll break down like, here's like mistakes I'm seeing LPs make, or what all these different fees are you might see in a deal, what they all make. And then another episode, I'll have a guy on who's a real estate sponsor. He's got 800 million of property, another guy in Chicago. And let's pick his brain. How did he get to 800 million? And so it's been fun. It's a bit of work. So if you want to check that out, it's called the Breneman Blueprint, and it's basically available anywhere podcasts are, and also on YouTube if you want to watch me on the mic. So
awesome, Drew. Really appreciate it, man. Certainly appreciate the thoughts on the book as well. Appreciate your time today. It's been a great episode, and hope you have a great one. Thank you so much.
Thanks for having me.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Breneman Capital's website, breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording, and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.